Good morning, everyone. It's Darius Dell here to present our second edition of Macro Bundle Q&A Live. I'm joined by the always wonderful Nadine Terman out in San Francisco, out in Menlo Park, excuse me. How you doing this morning, Nadine?
Good morning. Good morning, Darius.
Yeah, good. So I heard you're a little under the weather, so we appreciate you taking time to be with us regardless.
No worries. It's the tail end, so that's looking up.
The tail end is always better than the beginning. So in terms of what we want to get through today, and before we open it up to questions, this is something I wrote about in our leadoff morning note this morning, which is the dispersion analysis that we highlight on a daily basis. It actually started to tilt back towards defensives at the margin. Now, still very overwhelmingly pro-cyclical, but as we look at the chart here on slide 19 in our macro scouting report, you're actually starting to see something like utilities, low beta, and my friend REITs, although you can make the case that REITs is only sort of half defensives. But the reality is we haven't seen much defensive representation in the upper quintile out of the sample of 50 U.S. equity sectors and style factors that in this sample. And to me, I think that really speaks volumes to sort of a couple things. One, market actually might be sort of, differentiating between, let's say, higher quality cyclicals relative to lower quality cyclicals here in earnings season. I mean, obviously you got, SPACs have been a dog,
Sure.
most short at high debt, most short at low debt as well, most short at low beta. This is something I've been talking about. Shorts have been broadly working all throughout earnings season. And this to me is really kind of it dovetails into my second point about the sort of the compositional change that we're observing in real time here, which is the outlook from a bottom-up macro regime perspective remains pretty balanced. This reflation right here in Q4 that we expect again, because we think these I's will transition to R's as a function of our nowcast process. But the reality is these R's aren't like the R's in the prior part of the year. The prior part of the year, we were seeing record demand, obviously fueled by fiscal stimulus, really easy base effects, and obviously vaccinations and reopening was also a positive shock to economic activity. We don't have any of that stuff anymore.
Yeah.
So all we have is coming out of the sort of peak impact of Delta, and ultimately what that's likely to do on a temporary basis to growth statistics, both in the U.S. and global economy. So that may be why you're starting to see that style factor leadership start to go back towards more balance, which is obviously something we've been preaching for the last couple of months.
It's been interesting, Darius. So we've had some client, end of quarter client calls and potential client calls, and it's not a shock to anybody when we're talking about slower growth next year. So decelerating growth of GDP. No one's really shocked about that. They're trying to understand the timing of it. How do you position for it? But maybe can you go back to the dispersion sheet on page 19? One of the things, I think it was the second one up there, that I find really interesting is energy. So, obviously you're seeing the REITs and utilities, you've got, low beta, so those are new. But you see energy up there. What should we make of energy still being up, with high on the dispersion?
Yeah, no, I think this is I think the market is doing exactly what we did, which is say, hey, look, inflation or stagflation, as most of you guys know it as, that's the highest probability macro regime, at least for now, at least until we get data that now casts us out of that state. And as long as that's the highest probability macro regime, it would be extremely imprudent to not at the bare minimum allocate towards things that can actually sort of, protect your portfolio from any sort of economic downgrade to economic growth expectations as a function of rising energy prices. This is something we called out in the early part of this, in early, going back a month ago when we said, hey, look, you look at Europe in particular, clearly the stagflation exercise that we're seeing here, this is looking at something like the city inflation surprise index for Europe relative to the gross surprise index. This divergence is something that, hey, we're kind of at these cyclical peaks and troughs that tell you that,
Sure.
hey, maybe it's gone too far,
Okay.
stagflation. But the risk is that it didn't, and it actually continues higher, the red line, and the blue line continues lower. And so that's why, going back to our portfolio construction, we very deliberately said, hey, look, we want to have exposure to things like energy well represented in the portfolio construction. And I think going back to your question, I think that's what the market is doing and saying, hey, that's a very pure play on a lot of the risks to the downside with respect to the economy and asset markets in general.
And are those under-owned, would you say? Or how does someone think about, if let's say someone hasn't allocated enough to energy, how do they understand the timing of adding to that? Or are they too late to the party?
depends on the duration. Yeah, the depends. So
Sorry, I'm
definitely,
starting off hard.
So it depends on your duration, right? If you're an investor that has the sort of turnover ability with respect to your tax situation, that can in fact take advantage of the fact that these not the fact, but the expectation that these eyes transition to R's in this period here,
Yeah.
then it's not too late to be long energy.
Okay.
You should be buying dips on energy. And oh, by the way, we're only a week and a half into reflation
Right.
being the dominant market regime. I'm sorry, that's probably easier to see on slide 8. My apologies here. Oh, it's frozen. Anyway,
Yeah.
we're only a week and a half into reflation being the dominant market regime. So that's not exactly something that says you got to go be long or short energy, right?
Sure.
Yeah, exactly. So the reality is when you look at it from a medium term perspective, there's a lot of blue.
Yeah, right. No, that's
And if
like
you learn,
yesterday I was with a big pension head. I'm like, so what I see is a lot of blue. You see a lot of blue and some red in there. And, we kind of talk about there's, two ways you make money on that. The first is the first turn where people are, reflationary and they have to get to deflationary. And the second one is actually when you start trimming your deflationary and get more protection on because liquidity becomes a problem if the deflationary trends are hard. Like if you're in a deeper D, if you want to call it in your grid. So it doesn't mean it is going to go there. It doesn't mean there is a crash, right? But you have to be a lot more careful because you get kind of these two waves of capital allocation from offensives or cyclicals to defensives, and then out of the market. So it's you have to thread that needle a lot in a more finer way. You can't just be holding onto your deflation, think it's going to run for, I don't know, 6, 9 months.
is the exercise, in my opinion. To me, think about this sort of. We're going to get to a place in mid to late Q1 where the pace of economic deceleration starts to quicken, i.e., we start to accelerate to the downside with respect to the sort of, I wouldn't say repricing, but the jump condition lower
Yeah.
in growth coming off of this obviously very record run of both, fiscal stimulus, reopening, base effects, all this stuff. And we're actually going to have to start to decelerate a little bit faster as we get into mid to late Q1, early part of Q2. And so, I think that is the sort of with respect to this table, because obviously the D's really start to show up a little bit sooner than that. I don't know that the market risk shows up right in that particular interval. I think the market risk is likely to be more concentrated to when the pace of deceleration really starts to accelerate to the downside. And this is something
Okay.
that we know from our great asset market backtest. This is not for deflation or reflation. This is actually programmed for R right now. But in D, when D's a 0 sigma delta or you typically have positive expected performance.
Okay.
My head.
I'm glad you're bringing this up because that was going to be my next question. Is just how do we know that people won't sniff that out early and in December start repositioning for D? And what your point here is that you can actually have positive expectations in the market if you're just kind of starting in the D, but you have to get to whether I don't know if it's a more higher conviction D or a stronger D to be able to have that greater dislocation in risk assets.
That's exactly it. And oh, by the way, something I've been talking about as well. It's like that should perfectly time up when this line goes from I don't know, it's going to be flattening out all the way through.
Yeah.
Very likely that they announce tapering next week. I haven't seen anything from an inflation perspective or Fed communication perspective that says they won't. So it's really just the reality is okay. When does the Treasury come back into the market and really start to force this line down?
Yeah.
My expectation, just based on reading the tea leaves from the Treasury Borrowing Advisory Committee and obviously the tea leaves with respect to the budget resolution process, is that's likely to be a Q1 or Q2 event. And so it all can sort of come to a head with respect to the market risk associated with a not 0 sigma delta deflation, much more of a 1 sigma or 2 sigma delta deflation, coinciding with kind of the return of the bully with respect to the Treasury market and ultimately coinciding with or conflicting with tapering as it relates to net liquidity provision for risk assets.
So can you, one of the other things, if people have been reading through your slides like I have this morning, one of the things that jumped out to me, other than your dispersion analysis with Cacury, right? I'm thinking about doomsday signals and I'm looking at Cacury and you're telling me it's really falling down. You see the purple line hitting down pretty hard. That makes me worried, right? But I've seen other instances, I look to the left, or it doesn't mean the market's going to go down, but maybe put this in context for us here. how do we use this and think about affecting our portfolio construction, or at least risk management protocols relative to this signal?
Yeah, so that's a great question, and I think that the simple answer is that it's one of the many tools in the toolkit. Obviously, if Cacury gets into the consensus complacency zone or the danger zone, I like to call it as well, that is a big warning signal as it relates to the forward outlook for asset prices. But that doesn't necessarily mean you need to move to cash or sell exposures at that particular interval. Typically, what we found, and I've done, I did some work on this morning, is that you want to see it rising out of the complacency zone.
Okay.
That's the sell signal. The sell signal is not the first foray into the complacency zone, but rather the big move out of the complacency zone. And obviously, you're going to have some false positives with any quantitative process. Make no bones about that. But the reality is, I think you have to marry it up with your forward expectations with respect to the macro economy. If
Okay.
Cacury goes into the complacency zone, and oh, by the way, we're in this like big bright green. Sorry,
Right.
I'll go back to this. We're in this big bright green block. You should say, hey, well, people should probably be complacent because it's a big bright green block. The issue is when Cacury goes into the danger zone, when it's not a bright green block, but it's a red block or a blue block. And more importantly, it's a red block or a blue block that is characterized by more rapid deceleration in economic activity. That's the big scare zone
Yeah.
as Cacury.
And the other thing, maybe you can stay on this sheet here. The thing that I try to get my arms around, because the grid is one tool as well, right? It's one thing you have to look at, and you can see in the sea of blue that there are some steady greens. India is an example, right? But if some of the larger economies like the U.S., China, even Eurozone are more heavy in the actually, because Eurozone's got a couple of G's, but more D's, right? Can those other countries thread the needle, or can they not? You know what I mean? Is it just like, yeah, I'm glad you've got some G's going on here, Ireland or whoever, Indonesia, India, but when everybody else is in a D, I don't care. Or can you actually allocate, to one country and short other countries and make money on that? How should someone look at this and make sense of the differentials here amongst countries and regions?
Yeah, I think that's a fantastic question and perfect for someone who manages global equity money like you do. You can do that if you're a benchmark investor. I
Okay.
do believe that there's a lot of sort of value in the process and overweighting geographies relative to the benchmark.
Yeah.
However, I don't necessarily think this is an appropriate position to take with respect to, oh, I'm going to go out there and buy Ireland, even though the
Right.
U.S.
Right.
is going through a bunch of
Right.
Ds and net liquidity is going to inflect lower. That to me is on an absolute basis that'd be a very imprudent trade to make. However, you can overweight in Ireland relative to a Spain or an Italy in a benchmark, in a global equity benchmark, because the growth dynamics are likely to be rewarded by the market at the margins on a relative basis. As you know, certain parts of this game are extremely relative; other parts of this game are absolute. And
Right.
one of the times in which you can use the process for the former.
So Aiden Group has a question, and it somewhat relates to this. And that is, saying it's been a bizarre earnings season this year. Money's plowing into safe trades like Microsoft and Google, although I'd argue Microsoft had a great quarter, but the Russell's getting punished, so IWM. Are there thoughts on that? How does someone, can you, I guess, extrapolate from those type of or different returns into what you're seeing into this macro model?
Yeah, no. First thing I would say is that grid zero is a really stupid idea when value is ripping against growth and small caps are ripping against high beta a couple of weeks ago. And it's a fantastic idea now that those things are corrected. That's the whole point of grid zero is you're not going to get this unbounded return and recovery in things like value, things like small caps relative to growth, relative to mega caps, as a function of the economy. It's just not doing what it did in this period here. It's just not doing what it's did in this period here. So you should not, in my opinion, should not expect the same results. So this has been a very weird earnings season. In fact, prior to the show, you mentioned something that I think is really instructive to talk through, because I actually don't know the implications for it. I think it'd be helpful if you and I both talked through, at least in front of the listeners, because maybe we can get to an answer together, which is, you said some of the companies that you guys are long, or maybe not long, or at least the bare minimum on your watch list, they report good numbers, particularly on the guidance front, and actually still down. Talk to me about that, what you're observing there, and actually kind of what that might actually mean for the market in general.
Yeah, we're talking about that with Visa, right? MasterCard hasn't reported yet, but Visa came out in really good numbers. But on the call, they were talking about cross-border transactions, and that's when I think everybody decided to bring it down 4 or 5%. And so, I guess earnings season isn't enough in terms of what you're printing and the guidance you're giving. But I think people are trying to read tea leaves. All right, they're trying to read tea leaves of what could hurt you later. So I'm glad you made it this quarter. That was, the absolute bar that you had to hit. But now the relative bar for me to reward you is going to be, giving me all positive signs looking ahead. And the same thing, I mean, you look at somebody like Twitter, right? They're just saying, oh, we got a wind at our back, and the thing is down like, I don't know, 8, 9%. So we're just looking at some of these stocks, and obviously MasterCard is in sympathy with Visa, especially because of the cross-border transactions. But we're looking at those and saying, okay, how are people um, thinking about this earnings season? And I think they're very jittery. And so, like, you have to be, have perfection in your numbers and your guidance and your, earnings Q&A to be able to get through this earnings season with a positive result. But I want to go to one of the questions from Brian from Denver. And this was actually a question we got as well, is like, we know that grid zero doesn't happen all the time, but when was the last grid zero period? Like, how often has this happened? Have we like stuck around in grid zero for long times before? How should people think about, I guess, the longevity of the current situation, and then looking at versus historically what we've learned from this type of situation before?
Yeah, so the first part of 2014 is probably the last kind of persistent grid zero type situation that I can recall off the top of my head. I'd have to do some more back testing with respect to prior cycles, going a little bit further back than that. But as you remember, 2014 was a hard year. I mean, I think it got easy in sort of in the mid to late summertime when it became very clear that deflation would become the obvious macro regime, both from a market regime process, but also with respect to the bottom up macro regime process as well. It was very hard to risk manage 2014, the first half of 2014. I mean, there's a lot of sector and style factor ping pong, kind of like what we're seeing this year, right? You look at a chart of the S&P 500, or you look at the year-to-date return of the S&P 500, and it's been an easy year.
Easier, like, oh, you think you should be up 40, right? It's
Yeah,
like
totally. But it's been quite the opposite, right? Because again, like, we've had such aggressive sector and style factor ping pong really since kind of the Fed came out and started talking about tapering in June, and really it just so happens that they came out and had that conversation right around the time that the we were transitioning
right.
from ubiquitously accelerating growth to something that was a lot less ubiquitous. In my
Right.
opinion, we actually ticked down. If you think about July and August and September and the growth data, we're going to likely to tick back up in October, November, maybe even December, but then it's back down.
I've got a few questions here in the queue that I want to get to. Larry Baxter had the first one. Do you have any
All right, what's
portfolio
up, man?
hedges that you like to use in times of elevated risk, or do you just prefer to manage via risk, call it allocation, so changing exposures?
Yeah, I think the you can get yourself in trouble over trading. I mean, I'm sure everyone is everyone participating has figured that out by now. So I'm not. Yeah, exactly. So that's I mean, I think like the best. So in order to manage the cycle, you're going to be better extracting risk premia from things that the market is going to take away eventually, right? The market, if we're going into a series of deflations and buying yields are really high, the market's going to take away that risk premium because eventually investors will have to chase. That's the simplest way to hedge with risk with respect to the cycle. Obviously, you can put on a bunch of shorts and buy a bunch of volatility, pay up for a bunch of puts, but that really sort of that really caught that puts the onus on your ability to time markets rather than your ability to actually rotate into the right exposures at a reasonable point near the peak of the economic cycle or the peak of the inflation curve or something like that. I think that's a much easier, simpler process. Now, for those who are obviously much more sophisticated and have the ability to time markets on a consistent basis, obviously you can use options premium. You can use things like the VXX, VXZ, things of that nature, those types of exposures. Obviously, you can go out and short exposures as well. We'll see. You'll start to do a little bit more of that kind of stuff in the portfolio construction when the time calls for it, and the tools actually support being able to do that in real time. But the reality is, I just think you don't need to be a hero if your goal is to make and save money. If your goal is to make money in down markets, then it obviously has a very different that's a very different a set of
So no,
exercises
yeah,
than actually
yeah.
just protecting capital in down markets.
I think the only thing I'd add is kind of having your playbook ready. Doesn't mean you're going to execute on all the pieces, but
Mhm.
one good example is we have some international long only accounts. We're not allowed to hold more than 5% cash. We're not allowed
Mhm.
to have any hedges, no credit. So you have to be, fully invested for the most part in long equity. So in that case, it's all about asset allocation and understanding in times of risk who can actually just save your bacon. So as you said, they're not going to give you bacon, but they just save you from giving your bacon away, right?
Brilliant.
And so from that perspective, I think it's helpful whatever your mandate is, and you may be like us and have several mandates. One can be fully hedged, the other one might be semi-hedged, the other one's long only. But what can you do to prepare
Mhm.
in those instances so that you're at least ready? You have your playbook. Like I happen to know Japanese drugstores just basically go flat, maybe a little bit up when everything else is freaking out. So, if you're allowed to own them, that's like a great place to go and hide. Maybe a gold royalty company as well. So there's certain things that you can get into in exposures, but then you also might have your wish list in shorts and wish list and hedges, and it might be relative to your existing portfolio. You might be like, oh, here's ones where I can alpha make money no matter what, and other ones are like, well, at least I'll protect the bacon I have. Right. So how do I protect what I have if I need to do this quick? Because as you know, many of us have, tax paying clients. So we just can't sell. Like we have big Microsoft positions. We can't just dump a Microsoft position going into D. We might
Right.
have to be putting puts or other kind of hedges on to be able to protect that. So Larry, I think, adding on to what Darius says, it's about kind of knowing whether it's account by account or per strategy, what is it that you might want to do so that you're not kind of figuring that out. So you got your spreadsheets ready, you can have things kind of loaded to be able to execute versus thinking about what you want to do that day.
Yeah, totally. You never want to be thinking too much when the VIX is above 30.
No,
You definitely want to be very
no.
serious thinking before that.
Yeah, exactly.
Yeah.
Another question, this actually gets to rates. So Robert Weisenberger, where do you see the range for the 10-year going into next quarter?
Good question. So I've been making this either hilarious. I think it's hilarious. But I also
What?
find it funny. This joke: Jackson 5 versus Hanson Brothers. And so going back, yeah. So going back to and it's actually worked quite miraculously for, or not miraculously, but it's worked quite well for the 30-year, less so for the 10-year. But the point of the joke was that, hey, when we saw this sort of evisceration of
Yeah.
duration, the duration evisceration of Q4 of 22 through Q1 of 21. That, in my opinion, was driven by five things that almost never happened at the same time. We called this out in real time, going back to last fall. And I say, hey, look, we're going to go into a period where growth's accelerating markedly, inflation's accelerating markedly, corporate profit growth's accelerating markedly, the Fed's easing materially, and fiscal policy is easing materially. There's been like 10 quarters since, not like, there have been 10 quarters since 1960 where all those things are happening. And so clearly, this was a very unique economic environment. And in that unique economic environment, the nominal 10-year got up to 174, the nominal 30-year got up to 245. Well, we don't have that unique economic environment right now. That's what I mean by the Jackson Brothers. We
Yeah.
certainly don't have this sort of material acceleration in growth.
Yeah.
We no longer have a material acceleration in inflation. We might see inflation tick up a little bit in October and November as a function of base effects, but it's not going to be this ubiquitous,
Right.
trading
It's not going
power.
to be this huge surprise as well, right?
Exactly.
It's like that's all the other thing is it's not like it's going to totally change consensus view.
No, not at all. I mean, if anything, it's just gonna just gonna add to consensus view. That's what I mean by that. We were heading into this, going back to
Yeah.
that Jackson 5, and now we got this heading into your buddy. I don't know the Hanson brothers' names. I'm not sure if anyone does. They had a hit. They had one hit.
Yeah.
Anyway,
Yeah. Mbappe, wasn't
yeah,
that?
it slaps. It slaps. But anyway, so my point is the whole point of that joke was to say, hey, we're going to get to a lower high in bond yields, at least at this particular interval in the cycle, because I find it very difficult intellectually for bond just intellectually, both market wise in terms of the
Right. Right.
actual
What's going to
data.
bring that up?
How are
Right.
you going to get bond yields higher in this particular period? And I think that's what curve compression is already starting to tell us. You're seeing
So
yield
the
curve.
answer to Robert's question is 1.74. If I'm looking at your chart, you're saying it's not going to be above that.
Yeah, no, I don't see a scenario where rates go materially higher from on a nominal basis. I think you could continue to see break evens. Obviously, break evens have come up pretty materially in recent days, and this is this chart here. The black line is the 10-year break even, starting to decouple a little bit from the 10-year nominal. But what's really happened here in recent weeks is this real yield is really starting to pancake again, because I think
Right.
the forward outlook for growth for the bond from the bond market's perspective, because again, the bond market is not an equity PM trying to chase year-end performance. The bond market has a lot different sort of set of
Right.
characteristics that needs to analyze with respect to the economy. And real rates are now starting to go lower. They're starting to see this little bit of decoupling. You've obviously seen a decent amount of spread compression or yield curve compression. The purple,
Yeah.
the pink line is the 5 years, 30-year. That's all the way down. That's actually below 91 basis points this morning. And I think the bond market is looking forward into 2022 and saying, hey, at some point, people are going to have to come buy me.
Right. Right. And this gets to Adam P's question from Red Bank, New Jersey. Do you think long bonds will protect investors in deflation? He's skeptical, as it seems to be they could be a source of funds.
Yeah, I disagree with sort of the premise to some degree, and I think it's an excellent question. But I think you have to go back to slide 40 here, which
Yeah.
is we already like bond markets have already been a source of funds, right? It's so rare to see record amounts of cash and cash
Yeah.
cyclically elevated with financial conditions that very
So
easy.
low. Yeah. Yeah.
Yeah, so what does that tell you? That tells you people taking their money out of the bond market, not out of the stock market, like it typically happens when you see financial or
Yeah.
you see cash balances increase. And so to me, a lot of money sitting on the sidelines that refuses to go buy a bond because they're those investors
Right.
are concerned about inflation, and appropriately so. We're obviously at the hottest point of inflation, particularly when you look at something like median CPI. But I think as you go forward in time, let's say 2 to 3 months from now, once we're past this sort of secondary uptick in inflation and we're actually starting to see confirmation of disinflation, this is probably a late Q1 event. I think a lot of this money has to go find a home in a bond market, or at the bare minimum, you might see investors stop plowing funds into stocks and actually start to go look for things like bonds, because that's obviously
Point is that first move, you're going to see appreciation in that type of instrument. It's only that if you get a crash and people need liquidity,
yeah.
because what you're saying is they have liquidity. They have liquidity. It's sitting on the sidelines, so they're
Mhm.
going to be more willing to buy into that safer haven.
Mhm.
When yields are going down because maybe their equities aren't doing well, they're looking for something else. But then eventually, when they don't have liquidity, maybe that becomes the source of liquidity, but maybe you never see that second part of bonds where people actually pull out of gold and pull out of bonds because they weren't in it in the first place. So
Yeah,
they're under allocated. They have to allocate to it. So you might not see that actually be a problem.
yeah, you're absolutely right. And so let's say the nascent reflation trade that sort of reemerged in the last couple of weeks, develops itself into and through a year, and as I continue to expect it will, we get back to here, where the conviction in the reflation trade is extremely high and investors are extremely under positioned for anything but that. And that's when you
Right.
can start to see some asset class flows, out of equities and back into fixed income, particularly around the calendar year, right? Because there's going to be a
Sure.
pretty meaningful calendar
Rebalancing and yeah,
rebalance.
yeah,
This is one of
yeah.
the worst year. I think it is actually the worst year in the long, in the history of the long bond. And so you're going to see some calendar-based rebalancing at the end of this year and in the early start of next year. So I think that's going to be a governing factor on bond yields as well.
So Adam had another question that's related is, has the high frequency data disappointed enough for this reflationary regime to kind of stop out early? Got to my question of like, can the party end early versus prolong later into the first quarter?
Yeah, definitely. That's why I wake up every day kind of trying to handicap
So Adam,
without.
be watching Darius every day.
Yeah, well, don't watch me every day if you don't want to, but certainly, if I scream from the high heavens that inflation's over, pay attention to that. Yeah, I mean, so I would say at least the sort of leading survey data that we've gotten thus far for October,
Yeah.
on balance, because it's not ubiquitous yet, but on balance, we've seen tilts higher in growth. So like the
Okay.
regional Fed surveys, the composite PMIs for most of the economies that report the flash PMIs for October. I talked
So
about
it's not
consumer.
disappointed yet. Like the premise
Yeah.
is wrong. It hasn't disappointed enough. But if it did, you'll let us know.
Yeah, exactly. And really, it's the expectations is pretty important as well. I do believe if we bounce, that's going to be solid enough to keep the reflation regime going. It's
Yeah,
just not going to be solid enough to make someone go buy the highest volatility
sure.
earnings,
Yeah,
cyclical relative to mega cap tech company that
right.
might have a more persistent, prolonged cash flow trajectory. So that to me is the difference in the characteristics of it. Reflation. The reflation of the first half of the year of that reflation regime was characterized by rising tide lifts all boats. You're going to massive earnings recoveries and cyclicals off some pretty bombed out levels. And this one is more like,
It's like a little bounce. It's just like,
better than
you
it
like you
was.
did a good
Delta.
job. You did a good job.
Yeah, yeah, exactly. That's
Yeah,
exactly what
yeah,
it's the patronizing,
yeah,
compliment. Yeah, yeah,
yeah.
of course. That's exactly how I've been. You said that perfectly.
And
So
it's the
expect
last
that.
question here before we wrap
Yeah.
it up. Brian from Denver, thoughts on like a massive negative real yield on the S&P? Is it different this time?
Good. I don't know if we know the answer to that yet. I mean, it could very well not be. So this is the negative real yield on the S&P 500, the blue line. That's deflated by realized CPI, headline CPI. And as you can see where these dotted lines are, you're typically right ahead of a pretty material
Drop, yeah.
correction and or crash in the stock market, into those events. So obviously, this is not something to fool around with in terms of expectations, which is why I continue to say that we don't have a lot of margin for error, right? Right. Like, let's just, so one, this is the starting point. Let's consider this. Two, the expectation is that growth bounces in Q4. And
Yeah,
so, the extent that it does not bounce, that actually means the balance of risk is skewed to the downside. So
right.
as long as the balance of risk is skewed to the downside, and this chart continues to tell you that, look, we might actually be running out of scope to support the market with
Yeah,
easy monetary policy. If we actually did have a market event now, this particular
this could
juncture,
be, yeah,
it's going to
it's
be a
gonna hit
problem
us.
because
Yeah,
we're here at the chart, not here at the chart.
right. And then
that's
maybe
that's
go back to your asset allocation. We'll just wrap up with that. And that's why you have it more spread. You're not just totally in the R bucket.
Yeah. That's I've been saying that every day for
Yeah.
weeks now, which is I don't think it's prudent to fully tilt into reflation, even though I think reflation is likely to be the dominant market regime for extent, if not extent per time, for a few months at the bare minimum, or at least I think it's going to be the dominant market regime into and through year end as a function of a lot of dynamics that are elsewhere in the deck that we don't have time to talk about today. But again, it's not going to be the one that says this thing should be 100 and all these
Sure.
other ones should be zero.
Right,
It's
right. Go whole hog. This is not the time to go whole hog. And most likely, when you're seeing those implied volatility premiums turning into discounts and the dispersion heading into defensives being more represented, then start putting at least maybe raise a little cash, maybe spread it out to some other grid regimes so that at least you're not, if you are already, just fully in reflation. Yeah.
Yeah, I think that's a great plan of action, and we'll have to keep chopping the wood on the process each day in between now and then.
Thank you for having me. It's always fun to dig into your slides and the data, so appreciate it.
Always, Nadine. Thank you so much, and thank you all for participating. Replay will be in your inboxes shortly. Thank you so much. Cheers.